Good evening, everyone. I hope you can hear me.
Yes, sir.
Okay. So today's session is actually my first proper session on investing. In the last 2 years, I've taken dozens of sessions, but today is the first proper session exclusively on investing. And I would believe that it is the most valuable one also that I'm going to conduct. Now, I actually came about the idea for conducting this session when somebody messaged me a few days back saying that his portfolio was going down, and he was scared to sell his stocks because they were in a loss. And so I thought maybe I should share some perspectives, some basic things about investing, which will sort of help you deal with a situation where the markets look negative or they can turn further negative in the coming year or two. Now, in this particular session, I'll give you some aspects about how to mentally approach a time when the markets might go down. I'll also give you a very simple thing which will ensure that you do not, face sleepless nights. You do not worry about your portfolio much. And I'll also give you a portfolio itself. So from the theoretical aspect to the mindset to something that you can practically apply, I'll share something with respect to everything in today's session. And I mean, investing is such a broad topic. Hundreds of books have been written, thousands of pages have been written. It's absolutely impossible for me to, for anybody to deal with this topic in 1.5 hours. Especially when people ask me how to pick stocks, it's impossible for me to tell. There have been hundreds of books written. How can I explain that in 10 minutes? But despite that, I thought that I'll create some kind of content for today, which, you might find very helpful in terms of your investing. So I'll go through this presentation of mine, and after the presentation, you can ask your questions. All right. So let me start. So I'll take up 3 or 4 quotes from some great investors, and I'll sort of, give lessons through these quotes, which you need to absorb and, implement them in your investing. So this one is by Peter Lynch, and he says, you get recessions, you have stock market declines. If you don't understand that is going to happen, then you're not ready and you won't do well in the markets. So it's a very simple thing. If you cannot deal with the volatility of the markets, if you don't believe or accept that there are going to be stock market declines, you should not be in the markets. And now economies are cyclical, which is what makes market cyclical, because what is a market? It's essentially a grouping of companies. So if the economy is going up, the stocks will go up because the profits are rising, thus their share prices go up. But if the economy is going down, naturally the markets will also go down because companies face problem and demands, their profits go down. So obviously it's basically cyclical. If economies have to go up and then have to come down, similarly the markets will move according to the cycle of the economy. So these are very basic things that people might know, but they don't accept. And that is what I'm trying to do today. I'm trying to help you understand and accept these facts about the markets and about investing. Now, the most important thing here is to remember that they always recover. So we have had so many major depressions or recessions in the past hundreds of years. Every time the world has bounced back, every time the most significant one was 2008. Even after that, the world bounced back. So they always recover, which is something that you should always remember, because if you know that it's going to recover, then why are you worried about the value of a stocks going down? Okay. Now, if you can only keep your nerve and stay patient during the bad times, you will end up making incredible wealth. So it's very easy to stay in the markets when the markets are going up. But only those who can stay in the markets when the markets fall make actual money. I mean, do you think Warren Buffett used to exit every time there was a recession? No, great investors don't do that. They simply they have a portfolio, they stick to that portfolio, and they keep adding to that portfolio, especially when the markets fall. So if you simply expect to, ride the bull markets and then simply start exiting in panic when there is a sign of a bear market or a recession, you will never do well in the markets. Because, and this is something that I'll get onto later also, people try to time the markets. Stop timing the markets and instead increase the time you spend in the markets. Okay, so let your stocks stay in the market. Don't buy sell, do that kind of a thing simply because you feel that the markets are going to go down now. Let me exit, then when the markets fall, I'll enter again. That does not happen. That is not logical. Nobody's is that. That's basically something that only God will be able to do. That sell at the top and buy at the bottom. I'll get to this point later on also. But the first thing that you need to accept is that stock market declines will happen. And if you cannot accept this simple fact, you should not be in the markets. It's better to park your money somewhere else, because there's no use going through that mental trauma of seeing your portfolio go down. If you cannot, yourselves very well. So if you cannot emotionally take that kind of a downfall or a drawdown in your portfolio, it's better to put your money somewhere else. So this is the first thing. Markets are cyclical because economies are cyclical, and they always recover. And if you think that they won't, but basically, see, anybody who feels that they should exit in a recession is basically thinking or is accepting the fact that the world is not going to recover at all. So we are going to have a lifetime of recession in the world. Every economy is going to stay down, and we'll go through this phase continuously for the rest of our lives. If you don't believe that, then there is no logic in exiting your long-term investments when the market goes down, because eventually they will come up, right? Now, the next is, and this is a quote that you will have heard a lot: be fearful when others are greedy, and greedy when others are fearful, by Warren Buffett. So the basic logic of investing is to buy cheap and sell dear. Now, what people do is they will buy when the markets are moving up and sell when the markets fall. And that is just a second, somebody I think by mistake, they created this line on the screen. Hold on for a moment. Is the screen visible now?
Yes.
Okay. So what's important is to understand that we need to buy cheap and sell dear. So, you cannot be in a state where you think about selling when the market is falling and buying when the markets are at a high. So that's the basic logic of investing. That is when you will make actual money, when you'll buy cheap. And I get to this on the third point. The second point is that retail investors do exactly the opposite, because they let external noise affect them. So they'll see the news, they'll see other people, a neighbor will, start selling his stocks. So let me also sell my stocks. Somebody will send a WhatsApp message: market is going to fall, you should sell your stocks. You will also sell your stocks. Maybe your broker tells you something is going to happen, exit, you'll exit. But maybe you see the news and, somebody on business channels may advise you to do something like this, you'll exit, because everything that is happening around you is basically noise. If you can ignore this noise, only then will you be a successful investor. So let's say you are looking for a car and you get it at a 30% discount. You will immediately jump to purchase it, because 30% discount is you don't get on a car. Okay, if you're buying a new car, nobody will give you a 30% discount. But if you get Reliance at 1700 today, instead of the current price of 2500, if you are getting it at 1700, you will not buy the stock. You will fear buying the stock because you're attached to the price, not to the business. See, I tell everybody with whom I talk about investing, I tell them, if you're investing in Reliance, your money is as safe as it is in a bank. You're investing in the largest, one of the largest companies in the world. Now, if that company goes bankrupt, there is something much, much deeper, something much greater is the problem, rather than just, Reliance going bankrupt. So yeah, okay. So the problem is we get attached to the price of the stock, not to, we don't understand the business. We don't even look at it as a business. We simply look at the price of the stock. 100 रुपए पे है, कल 120 हो गया, आप खुश हो जाओगे, 80 हो गया, आप दुखी हो जाओगे. आप ये नहीं देख रहे हो कि उसके पीछे बिजनेस क्या है. There is a business behind every single stock that you're purchasing on the markets. So if the business is good, if the company is reliable, and if you get it at a discount, for example, Reliance at 1700, you're getting the same business, the same owners, everything is exactly the same, but you're getting it at a cheaper price. Why would you not want to buy? If you'll buy a car at a 30% discount, why would you not buy the stock at a 30-40% discount? So what I'm trying to say is stop looking at stocks in terms of their prices, look at it in terms of the business that they have. If you can understand the business, or even if you have a common understanding, basic understanding of what the business is about, okay, and if you have just a simple understanding of the Indian economy, you don't need to get into the details, but you understand that it's the fastest growing economy. Next 10-20 years, everybody's projecting growth for India. So why would you want to not buy quality stocks at discounts when you know that the future is bright for India and for these particular companies? I mean, if India is going to fail, nobody is going to succeed. That's a fact in today's economic scenario. So what I'm trying to say is, when the markets fall, you should move against the herd. And what is the herd? Everybody will get fearful. They will not look to put their money into the markets because they don't have this simple understanding, which I just explained in the previous slide, that markets and the economies will revive. They always do. If they don't, then your money in no asset is safe. If you are selling your stocks during a recession, then you should also sell your properties. Why? Because real estate will also not bounce back. If you don't expect, you should also sell your cryptos, sell everything that you have. Why? Because if you're thinking that the stocks are not going to come up, you're basically saying that the economy is not going to come up, because the stocks, like I just explained, are basically based on the economy, right? So if the stocks are not going to come up, the real estate is also not going to come up. So why are you still sticking with your flats or apartments or whatever you've bought as an extra investment? So please understand that the markets eventually come up. I'm not saying that they're 100% going to fall this year or next year. It's an educated assessment. Nobody can predict. This is also something I'm saying very clearly. If anybody tells you exactly, ab se girega, itne samay tak girega, they can do it once or twice, but nobody can be perfect at this thing. Nobody can predict these things exactly. But we should have a sensible idea of what might happen, and that is what I'm trying to share here. So if you get a quality stock at a discount in a country like India in a recession, you should, instead of being fearful and selling the stocks, you should actually look to put more money into the stocks, because you know that quality companies will eventually revive. They have the capability to come back up because the economy will come back up, and markets are cyclical. So they move up and they move down. Eventually, if a boom or an economic expansion ends, similarly, an economic recession also ends. So it's a cycle. It always moves in this fashion. So every time you reach a peak here, there's a downfall. Every time you reach a bottom here, there's an upside. It's as simple as that. Okay. So this is something, again, somebody made a mark. Just wait a second. Okay. So now the next point is, the next quote is basically, this is also from Warren Buffett. He says, okay, I'll do the permission thing next time. Okay. So he says, I have pledged to the rating agencies and to myself to always run Berkshire with more than ample cash. And most importantly, when forced to choose, I will not trade even a night's sleep for the chance of extra profits. Now, from this, I'll extract two important points. The first one is with respect to the coming year or two. I would suggest to keep cash in hand, about 10 to 30% of your portfolio value, simply so that if the markets fall down, you can put some money at those times. Again, I'm saying nobody can predict exactly when this will happen or how major it will be, but it's an educated guess, educated assessment. And that is why I would believe that it's not bad to have some cash in hand for the coming year. So this is the first thing that you can do. And the second thing is, your portfolio should be created in a way that it does not hurt your sleep. This is very important. And the most important aspect or the most important point with respect to this is, let me go ahead and I'll explain this. Invest only that money which you don't need. So only the money that you can put into the markets and forget for many years, at least 5 to 7 years, should go into direct equity. The problem is people put money for a short period of time and then they're worried when the market falls, and then they start panicking. But anybody who understands basic investing and who knows that investing is actually done for at least 5, if not 7 years, will never panic because he has such a long time horizon. And if you put only that money which you don't need in the short term, okay, absolute free cash that you have, if you invest that into the markets, you do that in real estate, right? Nobody reduces their expenses, reduces their necessities, and then puts into a real estate. Nobody does that. Okay, you only put into real estate also only the money that you have extra. Similarly, only put that money into the markets which is extra for you. I would definitely suggest that you should put as much into the markets as possible. And thus, even if you have to reduce certain expenses, extra expenses, it's good because you're creating an asset here. But still, only that money which you don't need over the next 1, 2, 3, 4 years, maybe even 5 years, only that money should go into investing. Okay, I'll get into these details also. You'll understand very well what I'm trying to say. Now, here is the most important point with respect to time horizon of investing. And this will clear a lot of things up for you. So Philip Fisher is a very successful investor. And in fact, he's an influence in Warren Buffett. So Warren Buffett was inspired by him in a certain fashion. He once said that his average holding period for a stock was 20 years. Just imagine this. People don't even want to keep a stock for 2 years nowadays. And it's so wrong that investing has been completely, it's completely been, मतलब उसका बिल्कुल मीनिंग ही चेंज कर दिया लोगों ने. 2 साल को इन्वेस्टिंग बोलते हैं, which is absolutely pathetic. Real investing is at least for 5 years, if not 7 years. Please understand this. What you're investing into the markets, and I'm using the term investing here. When you trade, the term is actually speculating. So there are 2 terms. Speculating is for trading and investing is for long term. So please don't use the term investing when you want to buy a stock for 2 weeks, 3 weeks, 2 months, 5 months, 6 months. That is not investing, that is trading or speculating. When you use the term investing, it should be used with that thought in mind, that I am looking to put my money into the markets for at least 5, ideally 7 years. Okay. So time horizon is of most importance here, because that is exactly what differentiates investing from trading. If you bring down the time horizon for investing to 1 year, 2 years, we are not doing anything different from trading. Now, in India, the problem is most people advising or teaching have completely distorted the meaning of investing. So the people teaching themselves use the word investing for putting the money into the markets for a few months, which is completely ridiculous. So, and these things nobody will teach you. Why they do this is because if I tell you to buy a stock for 10 years, and on the other hand, I give you 2 options: buy a stock for 10 years or buy a stock for 1 month. 99% of people would go for 1 month. Why? Because they want quick returns. Who's interested in buying a stock for 10 years? So the people advising or teaching in the finance industry purposely have very, many of them don't actually have the knowledge of investing. They don't actually know what investing is, while the others purposely try to, use this word investing for a very short period of time, 6 months, 1 year or 2 years, so that people get a completely wrong idea of investing and they can attract more followers towards them. Again, because if I tell you to buy a stock for 10, 15, 20 years, you'll not be as much interested if I tell you that I'm going to share stocks with you for 2 months, 5 months, 6 months. And the last point is your greed is what makes you attracted towards short-term returns instead of actual wealth creation. Now, please understand this. I'm not saying trading, you should not be doing trading. There should be a balance between trading and investing. Okay. But in trading, you're always cutting down your profits. If you get, let's say, 20% return in 2 weeks, you're very happy. But that stock might have the potential to give you 5,000% return in the next 5 years. If you're selling that stock for 20% and not keeping it for a return of 5,000%, you're making a huge mistake. So by definition, people, if you're exclusively attracted to trading, it's basically that, your greed is getting the better of you and you simply want to take short-term returns instead of focus on actual wealth creation. Short term में 10, 15, 20, 40% मिलता है, बहुत खुश हो जाते हैं लोग. But in the long term, I've seen stocks that have given over 10, 15, 20 years returns like 11,000%, 20,000%, 50,000%. So when you focus on short-term activity instead of long-term genuine investing, you are cutting your profits down and you're actually letting your greed get the better of you. And I'm repeating here, there should be a balance between trading and investing. It's not that trading is bad and only investing is good. In my opinion, investing should be for everybody and everybody should do it because it requires less time. You can do investing in a much easier fashion than you're doing trading. Trading requires much more involvement. But on the other hand, the problem is most people are interested in doing trading because they have this greed. I've heard so many people say to me, "हमको intraday करना है, हम 1,000 रुपए दिन के कमाना चाहते हैं, तो 20-25 हजार रुपए महीने के निकाल लेंगे." What happens on the day when you lose money? What happens when on a particular day the market goes against you and you lose 5,000 rupees? Have you calculated that into your calculations? If you want to earn 1,000 rupees every single day, you have to be 100% correct, which is absolutely impossible in intraday trading. You will be wrong, and the days that you're wrong, you lose money. So the problem is that people have, they've not been taught the difference between trading and investing and what investing actually means. Its definition is primarily based on its time horizon. So if you are investing, if you want to invest, please understand that you should be putting your money into the markets for at least 5, but ideally I would say 7 years. Before that, it is not proper investing. And this is what will create money for you, which I'll explain in a later point. Now, see this particular table. Less than 1 year, it is purely trading. Simple as that. And this is only done on the basis of technical analysis or chart reading. Anybody who tells you that I'm going to share a target for you for a stock for the next 2 years or 2 years from now, based on charts, he's absolutely fooling you. From the person that I have learned options, he's a very successful trader. He told me that it is impossible for one to analyze or give targets or expects, some kind of price levels beyond 1 year on the basis of charts. So the limit of being able to accurately read charts and deriving a value from it is restricted to 1 year. And that is purely trading. That is not investing. First thing. Second thing, if you are into the markets and you want to invest your money for 1 to 3 years, avoid equity. As simple as that. There's so many people who ask me to, I guide with respect to mutual fund investing. And just today, somebody told me that he needs about 50 lakh rupees to buy an apartment in 3 years' time. Now, if I were to guide him, if anybody else were to guide him, they will, for their own benefits, they might say that, yes, come, I'll help you invest for 3 years. I flat out told him, equity is not for 3 years. Please look at some other asset like debt funds. Why? You'll understand in the next slide, but this is just important for you to remember that if your time horizon is 1 to 3 years, avoid equity, look for other assets like debt funds. If it's 3 to 5 years, prefer mutual funds. Okay, reduce or keep a limit to your direct equity investments. Prefer mutual funds because they have less volatility. So if your time horizon is 3 to 5 years, go for mutual funds above direct equity. And 5 years plus, focus on direct equity, which means you're directly buying stocks. Now here, I just told you why 1 to 3 years is not a proper time horizon for investing. It's not investing at all. It's a very gray area. Till 1 year, it's trading. From 5 years plus is proper investing. Let's say even 3 years plus is investing with respect to mutual funds, like we discussed in the last slide. But that 1 to 3 years is a very gray area. It's neither trading, neither investing. And I'll explain to you in this slide. So let's say someone has a 2 years time horizon. Now Nifty today is at 17,800. It grows at 12% this year and the next year also, right? So it grows at a CAGR of 12%. After 2 years, Nifty will be at 22,300. Now, after 2 years or 2 years from now, there's a 40% fall in the index due to some crash or recession, whatever it is. Nifty will come down to 13,400. See how far below it is from the level that you invested. How many points? It's a lot. It's really a lot. It's significantly below, and there is absolutely no chance that if you're invested here, you would be at a profit here. It's absolutely impossible. Now look at another scenario where the investing is done for 10 years. Same Nifty, same rate of return. After 10 years, Nifty will be at 55,000. And then if it suffers a 40% fall, Nifty will come down to 33%, but it is still nearly double the level at which you started investing. So there's absolutely no chance that you will be at a loss at this particular point in time, despite a 40% fall, because this level is still nearly double your investing level. This is why the longer the time horizon, the lesser the risk. And this is why I clearly say to anybody who asks me, what should I look at for a period of 1-2 years? I say, don't put your money into equity. Put it in a debt fund or fixed income place where you get a fixed return. You know that your capital is secure. You don't have volatility, and you'll get something 5, 6, 7, 8%, whatever it is, return every year. So this should make it absolutely clear to you that if your time horizon is 1 to 3 years, don't go for equity. If it is less than 1 year, that is purely trading, which is done on the basis of charts. If your time horizon is 3 to 5 years, I would suggest go entirely for mutual funds. And if it is 5 years plus, it is then that you should start focusing on direct equity. Now, I've spoken a lot in these last slides. I've spoken about a lot of aspects. So by now you understand that it is absolutely essential to invest with a long time horizon. And I've shown you in this slide why. The benefit of keeping a long time horizon is that despite a significant fall or a crash or a recession, you still end up at a stage where you are in a very good profit. In this case, if you see, your portfolio will still be at least double. It's just a random thing that I'm saying here. But if the index is double, your portfolio will be many more times than what you'd invested here. But this is factoring in a significant fall in the index. So this is why investing should always be done with a long time horizon. This one I've already explained to you. Now, your best friends in investing are time and compounding. So I had a slide. I don't have it right now, but if you plot a chart where you've invested, let's say 100 rupees now, and you're putting it for 20 years, and you are compounding it at 10% every year, the chart goes something like this. Okay, so what this means is during the first, let's say 5 to 10 years, maybe 3 to 7, 8 years, the growth is slow, but then it really starts to take off. So I've seen this in mutual fund investing so many times that the money that you make in the first 10 years, if you compare that to the next 5 years, you will make much more money in those 5 years. And then in the next 3 years, you might make more money than the entire first 15 years. So the longer the time horizon, the more the effect of compounding. So if you're actually investing, you should take help of your best friends, which is time and compounding. So the problem is, like I said, people have distorted the definition of investing. They talk about it in terms of 1 or 2 years. If you have that kind of a time horizon in mind, and if you're thinking that is investing, you will never make any money because you're not letting compounding come into effect. So this is very important. That is why keep your money into the in the markets for as long a period as possible, and you'll make a great deal of wealth. Now, if you cannot pick stocks, simply invest in mutual fund based on goals. Now, creating equity portfolios is very difficult. I mean, people ask me to guide them, but even for me, it's not easy to do that for everybody. So I started guiding people on mutual funds. So I create portfolios for mutual funds and I create them on the basis of goals. So if you don't, or if you cannot pick stocks, you don't have the knowledge or the time or both, just stay away from direct equity, go for mutual funds based on goals. So whatever goals you have, child's education, child's marriage, buying a house, any goal. And one goal that is common to all is retirement. Everybody has to retire, right? So for some people, it is that when they retire, they want enough money. Let's say you're 40, you want to retire at 60, or you will retire at 60. So you want enough money then. For others, if they're 20, 25, they want early retirement. So they want to retire at 45 or 50. So retirement is a common goal for everybody. But the process is, it's not about selecting mutual funds. It's about knowing how much you need for that particular goal. So the process is identification of goals, identifying how much corpus you need for the goal, and then doing a reverse calculation to come at an amount which you need to invest every single month to reach that goal. And the final step is to identify the mutual funds. People focus on the last step. They think that mutual fund selection is the most important thing. No, it's not. If you need to invest 10,000 rupees every month to achieve your goal, but you're investing 5,000, no matter, even if you select absolutely the best mutual funds in the market, you will still not be able to achieve your goal because you are under investing. So if you cannot pick stocks, simply go for mutual funds. Now, it is important that you start identifying stocks in your portfolio that are good businesses. Now, again, this is related to stock picking, which I cannot enter into right now. It's such a detailed topic, but at least, one thing that you can focus on is try to invest in only those stocks or those businesses that you can reasonably understand from a common man's perspective. Okay. So FMCG, for example, you can understand that from a common person's perspective. You buy these products, so you can understand what kind of demand they have had in the past, what kind of demand they might have in the past. Even using common sense can take you a long way into selecting good stocks. So if you want to avoid picking bad stocks, simply ignore the kind of businesses that you don't understand. For example, chemicals. Okay. It's very difficult to understand that sector. So any sector that you cannot understand, simply ignore. There are enough stocks in the market and enough sectors also. So just using common sense will help you narrow down the stocks in your portfolio to a few very good companies. Now, never sell truly long-term holdings during a recession. I've talked about this in the past few slides repeatedly. But it's very important to keep investing during a recession, especially in mutual funds, because you're getting the same quality companies at a cheaper price. So when the market starts to rebound, see, when you trade, every single person who's joined any of my previous trading courses, one thing is common with every one of them. They've averaged in trading. So whenever they bought a stock, let's say they bought for 100 rupees and the stock fell to 95, they will add more because they want to bring the cost price. Then they'll move to 90, they'll add more. Their only focus is they want to bring down the cost price. But when it comes to investing, people don't do this. So when there's a recession, people sell their holdings. Why? If there's a recession, if the market goes down, it's important to average. And averaging is not for trading. And this is something that I'll cover later on in a separate short course that I've created. But please remember, there should be no averaging in trading. It is a concept exclusive to investing. So if the markets are going down and good stocks are going down, good funds are going down, it is the right time to put more money into them because you have to average. If you do averaging in trading, which is actually wrong, then you should absolutely do averaging in investing, which is the right way to go. And the last is never try to time the markets. So many people ask me or tell me that they want to exit their portfolio now and then buy when the market falls. See, I tell them, can you predict when the markets will bottom out? Can you invest exactly at that point? So many people have sold their stocks or they sell their stocks in the hope that they will buy later on. And trust me, they're never able to buy it. It never happens. You can try it for 1 or 2 years, sell your stocks and see how many stocks you're able to buy later on at lower prices. Same quantity, you will not be able to do it. It's not easy. It's very difficult, and it's actually not logical also. Investing is about accumulating. It's not about booking profits. It's not about, buying today, selling in 1 year, waiting for a fall, and then let's say you buy 100 shares today, you sell in a year at a profit, the stock comes down, you sell, and then again you buy 100 stocks in the hope that you'll make another profit in the short term. This is not investing, this is trading. Investing is about adding to the quantities that you originally hold. If you keep buying and selling, you'll end up with the same amount of quantities, which does not lead to wealth creation. Plus, when you're booking a profit, you're paying tax also. So never try to time the markets and keep adding when the market goes down. So don't try to be geniuses, because even the actual geniuses have admitted that they cannot time the markets. They've failed to time the markets repeatedly. That is why what they do is they keep their good stocks through recessions. They will put more money into the good stocks when the markets go down, but they identify that yes, something might be turning negative, so they keep cash in hand and they use that cash when the markets fall down. So that is actually what I'm telling you is actually what the best of investors do. They keep cash aside and they start putting money into the markets or into the existing stocks when the market goes down. So that is what you also need to do. Now, this is something extra, but I just wanted to sort of share this with you. Just a general knowledge kind of a thing. So these are the various sectors, the major sectors, and this is about the 2008 recession, and this is the 2020 COVID crash. Now I have arranged these numbers in a descending order. Now, if you look at the COVID crash, almost every sector fell 25, 30, 45, 50%, because it was just across the board. There was fear and everything was, going down. But if you look at the current situation or the future situation in the next 1 or 2 years, the situation is about an economic recession. This COVID wasn't an economic recession, it was fear. 2008 was an economic recession. That is what is expected to happen in the next 1 or 2 years. So these figures are more appropriate for us. So see which sectors fell most in the 2008 recession: realty, media, infrastructure, banking, IT, auto, and energy. While these two did not fall. So can anybody tell me why these two sectors fell the least?
Because consumption of neither pharma nor FMCG ever cools down.
Yes. So basically they're defensive sectors, defensive stocks, which basically means that people have to consume or they continue consuming these things. So the demand for these products don't go down as much. Whereas realty, media, infrastructure, banking, everywhere where a lot of cash flow is involved, which is about, look at realty, for example. It's about buying property, selling property. So obviously in a recession, you'll stop doing that. So that falls. Media, this is the most useless sector for me. I don't think you should invest anything in media. Infrastructure, again, if the market goes into a recession, investment into infrastructure reduces. Banking, loans, the disbursement of loans reduces, so banks suffer. IT, same thing, demand reduces. Auto, demand reduces. Energy, demand reduces. Yet energy is a sector that still fell relatively less. Relatively less as compared to the other sectors. Why? Because energy is still a need, right? For companies, for people. So energy still fell less because it is still a need. But these two are the most defensive sectors.
Hello. Yes. Isn't energy? I think so.
Let me complete. I said
Okay.
ask questions in the end. Yes, please. Yeah. So these two sectors are the defensive sectors, and this is how basically, when you enter into a recession or when you're going into a recession, these are the things that you need to keep in mind, and maybe you can sort of use this data to sort of reassemble or rebalance your portfolio. So this is something that, like I said, is general knowledge and you can use it to your benefit. Now, like I said, I've created a basic portfolio for defensive investors, which means that this is for investors who don't have the time or knowledge or both to create a portfolio. And this is basically buy and forget kind of investing. So, you have to buy and you have to just keep it with yourselves and forget it for a long period of time. Now, I've selected all large cap stocks to reduce the volatility, but returns are also restricted because you cannot expect a large cap company to grow at 50% annually. You can expect a small cap company to grow at that rate, but not a large cap company. Similarly, a small cap company might also fall 50%, but a large cap company won't. Now, strict allocation of 3 to 5% for each stock. Okay, so your allocation should be anywhere between 3 to 5% for each stock. Don't let it fall below this or go above this. Don't try to, say that I like one stock a lot, I'll put more into this, and I don't like a particular stock, so I'll put less into this. And keep adding to these existing stocks on a regular basis. Now, I've selected these stocks. I won't go into the reason why I've picked them or why I've ignored the others. That is something which is completely related to stock picking, but this is something that I'm just sharing with you because I thought I should give you something which you might look forward to from a practical approach, from a practical point of view, something that you can actually do in the markets. So please don't ask questions why I've selected this and why I've not selected some other stock. But these are the basic 25 stocks I've selected for you. Adani Enterprises, Asian Paints, Bajaj Finance, DMart, ICICI Bank, L&T, Pidilite, Reliance, SBI, Sun Pharma, TCS, Titan, Ultratech, InfoEdge or Naukri, Eicher Motors, Tata Power, SRF, SBI Cards, Ambuja Cement, M&M, Divi's Lab, HAL, Dabur, BEL, and JSW Energy. So these are 25 large cap stocks that there are 100. So I've brought them down to 25. And like I said, it's a defensive portfolio for defensive investors, which is something, of the kind that you can buy and forget. Volatility is reasonably less. Returns are also less. Strict allocation of 3 to 5%, that 25 stocks. So if you put 4% into each, you reach 100%. So you can vary the allocation from 3 to 5%. And this is basically the diversification that I've done, 25 stocks. So it's a well-diversified portfolio. It's basically like a mutual fund of large cap companies. You can say that. And if you look at the sectors, 4 stocks from consumption, 4 from banking and finance, 3 from infrastructure, 2 are conglomerates, Adani Enterprises and Reliance. So they have a variety of businesses, IT 2, pharma 2, chemicals 2, automotive 2, energy 2, and defense 2. So basically, all the stocks have been divided into 6, 9, 10 different sectors. 25 stocks divided into 10 different sectors gives you a very good diversification sector-wise plus stock-wise also. So this is something, I'm not saying you should do it or you absolutely must do it. It's something that I thought I'll share with you because this is the easiest way to sort of enter into long-term investing. Okay, it's not like if you create this portfolio, you have to keep this going in the sense that once like there are so many people, they find it hard to start investing. They don't know how to start. They don't know where to start. And I've seen so many people, the basic problem that they, the basic mistake that they make is they'll put 30, 40, 50% into a single stock. And then once that stock comes down, their entire portfolio comes down. Somebody I knew, he had put about 40% in Burger King. The stock kept coming down and his portfolio kept coming down. And there was absolutely no way his portfolio would recover unless he sold the stock at a loss or he, simply reduced or otherwise until the stock itself went up. So I've created this portfolio for you. You can look at it if you feel that you might want to, if you have not started investing, you can look at something like this and create this kind of a portfolio. It's a very simple portfolio to get you started off into investing. And later on, once you gain confidence, once you gain knowledge, you can start to, select stocks of your own. Lastly, just to end this particular presentation, see, investing success is not in trying to do the big things, but in doing the small things correctly. So again, people focus a lot on stock picking. That is the only thing that goes into the minds of people. How do I pick stocks for investing? How do I pick mutual funds? But if you cannot do the basic things right, and one of the basic things that I talked about in this session is mental discipline. It does not matter, you might select the best funds or best stocks, but if you exit them in panic, it's absolutely of no use. So I always say to people that I teach, success in the markets is, I would say, 70 to 80% emotional discipline and mental discipline. Rest 20-30% is analysis. It's not the other way around. So you can just created this portfolio for you. It's a simple portfolio, right? It's not an analysis intensive portfolio. It's common sense that I've simply used common sense to create this portfolio. But the success of this portfolio depends on whether you are willing to stay with it or not. If you exit these stocks or such a portfolio when the market starts to fall, you've done the exactly opposite thing that is expected of you. So the small things need to be done correctly. The larger things will automatically fall into place. Okay, now you can ask questions.
Hi, Vinayak. I just wanted to understand the sample portfolio that you had showed in the previous slide. Is that one of the general recommendations, or is it something that you curate specifically basis on the needs of specific people who want to work with you?
No, could you please explain a bit about what you mean by work with me?
Yeah, like for example, like there are people who are interested to, join you and then take your guidance in going through certain investment process for their long-term goals. So, do you curate the stocks or these investments which you are showing here? Is this a sample of such, or is this something that you generally recommend for anyone who wants to, whether they have any kind of goals? These are something the standard kind of investments.
Right, right. No, I don't, like I said, don't directly guide people for equity portfolios. I
Okay.
do that for mutual fund investing, not for equity portfolios. So this particular portfolio is something of a standard thing, irrespective of what your risk profile is, whatever you might feel about the markets. This is something that anybody can adopt. So it's not specific to a certain kind of people with a certain financial situation or a certain risk profile. Anybody who has, like I said, free cash to invest in the markets, and most importantly, a long time horizon, 8 to 10 years at least, I would say. If you really
Okay.
want to make money, you can sell it in 5, 6, 7 years, fine. But if you really want to make money, at least 8, 10 years, anybody can adopt this kind of a portfolio. And if you want to bring it, I mean, these are 25 companies. So you can maybe trim a few companies, maybe if you want to bring it down to 20. But I would suggest this 25 companies. It's a basic standard portfolio that you can have for yourselves for the long term.
I think he already shared the sector wise, right? So even if we see the sector wise and pick the stock which is
Sorry, I cannot hear you properly.
Hello, Vinayak.
Yeah, hello.
Yeah, I just wanted to know, did you calculate the return CAGR return for this standard stocks after 7 years or 10 years period? I mean, just wanted to have a rough idea how much percentage of CAGR we may get.
No, I have not done that. But
Okay.
for example, if you look at Asian Paints, I think it's given about 27%. Bajaj Finance is around 30%. Reliance is about 17-18%. TCS is about 17-18%. So basically, now look at HAL or BEL. These are stocks, and JSW Energy. These are stocks that are future oriented. So they might not have given much returns in the past, but these are based on what they can do in the future. Similarly, SBI Cards is one for the future. SRF has given very good returns. Tata Power is for the future. iShares and M&M, basically because of see, the reason behind iShares and M&M, simple. Like I said, you can use common sense to invest. These are auto companies. Their products are good, especially M&M. It has really evolved in the last few years. And plus, as India's economy expands, people's income expand. These are the things that people buy. So future centric. Adani Enterprises is a conglomerate. It can demerge in the future. It will give you very good returns. I feel long-term bet. DMart, consumption, safe stock. ICICI Bank, one of the best banks. L&T infrastructure. and Ultratech Infrastructure, Ambuja Cement Infrastructure. The biggest boom in India is related to infrastructure. So you have 3 stocks that are focused on infrastructure and can give you good returns. Pidilite has given, I think I don't remember, but I think above 32% annually for the since its inception. So this is an exceptional stock which has given extraordinary returns. SBI, you have exposure to public sector banking and the best public sector bank. Sun Pharma, very dependable pharma company. Titan Consumption, Dabur Consumption, Divi's Lab, dependable pharma company. Info Edge is a good IT company. So, I've just explained to you the entire very common perspective behind the selection of stocks.
Okay. Got an idea.
Hello. Hello. Yes. I have a question that falling down of a company, like you had earlier showed in the recession part, that it depends, I think so, more about the policy, because earlier the energy coverage was not much, you can say, in India, but after that in the COVID crash it fell less. Similarly, infrastructure, it was not that fast, you can say, very slow, but now it's very fast. So that's why earlier in infrastructure in 2008 it fell 62%, but this time 39%. So I think it depends a lot on policy of the government also.
No, see, like I said, this was an
and answer one more question, that demerger of a company leads to like boom in the original parent company from where it's demerged.
Yes, generally, because see, it's a very simple thing. If you are going to buy a stock today that has 10 different businesses under that particular company, now it's very difficult for you to get an accurate perspective of what the actual value of that company is, because it has 10 different businesses. Now, if it starts to remove one business from its parent company, what happens is then the valuation of that individual stock, the separate entity, becomes much easier for investors. So that stocks generally sees a boom. Plus the valuation of the parent company becomes easier from the perspective of investors. So that is why a demerger helps both the parent company and the demerged stock. This is the general case. Exceptions might always be there. As far as your question about infrastructure is concerned, I said that this is an economic recession. This was an overall recession in the sense that, sorry, not a recession. This was simply a crash. People did not know what to do in this particular case. They felt that, the world was ending and, maybe there's no cure to this particular thing. When you talk about economic recession, if an economic recession happens, I don't doubt that, again, these 4 or 5 sectors will fall the most, simply because it's related directly to capital infusion. So when the demand goes down, when there's less money in the markets, it is natural that infrastructure will go down. But having said that, yes, the one difference could be, if we fall into a recession in the coming 2 years, infrastructure might do much better than the 2008 recession, because the government's focus now is heavily on infrastructure. When the Great Depression happened in the US government simply ran a program to fund public infrastructure projects, and they brought out the economy through infrastructure itself. So this is one particular sector which I feel might do better than the last recession, but rest of the sectors could fall as much as they did.
Hi Vinayak, I have a question. Actually, 2 questions.
Yeah.
Could you also suggest good mutual funds for an investment point of view or long-term investment point of view? Secondly, do you expect the recession, and can the market go down further, or we should just wait for that phase, or we should start investing from now on itself in SIPs? What do you suggest?
See, first thing, as far as mutual fund investing is concerned, I don't suggest mutual funds simply because I just explained that I can tell you the best mutual funds, but if you don't know how much you have to invest and what your goals are, you will not be able to gain any success. So I've been doing this guidance for past 3 weeks now. I just started recently, and there was a person who said that she needs 5 crore rupees in the next 20 years. She's 31. She said she needs 5 crores at 51 for an early retirement. Now, when I did the calculations, the amount that she actually needed came out to be 9.7 crores. So it does, even if I had not done this calculation for her and I just simply told her, yes, buy this mutual fund, even if those mutual funds would be the best in the industry, but if she just went on investing, keeping that 5 crore in mind, her goal would never have been achieved because the actual corpus that she needs is actually double. So as far as mutual fund investing goes, the calculations are more important than the selection of mutual funds, which I do separately. And your second question was regarding the recession thing. See, nobody can tell when a recession has actually started. That's the biggest thing. So nobody can predict. So it might already have started, it might not have started. Nobody can accurately say that. So ideally, I would say that it's important to have some cash in hand. Have as much cash as you can in your hand as possible. Start investing from now, but divide this capital into the next, I would say 18 months. Divide this capital over the next 18 months. Start small right now. Don't put a lot in the next 2-3 months. Maybe start investing more from March and April.
Thank you. Thank you so much.
Yeah. Any other questions? How much can the market fall in 2023? Nobody can say. If anybody says that, they're simply trying to act smart. So we don't know how much it can fall.
Like one question, real estate stock or a real estate flat as an investment?
Sorry, could you repeat?
Real estate stock or a real estate investment as either a site or a flat. Even if you're living in one, I'm buying one more. What do you suggest?
Okay, so basically you're asking whether real estate as a stock investment is better or as actually investing into real estate, physical real estate.
Yes, physically.
Okay, so frankly speaking, I don't invest in any real estate stocks. The simple reason is that it's a cyclical sector. So it will move up, and then when a major recession comes, it moves down. So whatever growth it has made, it sort of gets nullified to a great extent. Even if you look here, 88% fall in Nifty Realty in 2008. So I don't invest I completely avoid Nifty Realty, Nifty Media for investing. I never put any money into these stocks at all. So I won't suggest Nifty, stocks into real estate. What you can do is you can invest into REITs, real estate investment trusts. I've shared a post on that in the group. You can search REIT and you'll find that there's a graphic about that. So that is basically, it's a company which manages the real estate, prime real estate in the major cities in India. So what you're basically doing is you're putting some money into it. And these companies, they get a rent from the people that they've rented out to. And these rents are then funneled forward to the investor as dividends. So generally, their returns are about 8 to 11% over the past few years. So if you want to invest in real estate, I would suggest you can put some money into REITs, and you can search in the group. I've named the 3 REITs that are there and which is the best one also. As far as actual physical investing into real estate goes, I don't prefer it at all because number one, the returns are not that good. Number two, you need high capital investment. Number three, it's not an easy process trying to, get the proper documents, trying to get them verified. Plus so many, it's reduced now, but in the past, there was so much fraud going on in the sector. Plus you block your capital for many years. If you want to sell, it's so difficult to sell. Plus the charges that you incur in buying and selling a property, these charges people don't consider, or they don't, really look into these. So I think you should not invest into real estate unless you have a unique idea and you can use that property to rent or to generate a good income through it. Unless you have that, you should not do it, because even if you rent out a property, I don't think you get more than 6, 7, 8% annually. So I prefer neither, actually, nor investing in physical, nor investing in stocks.
Thank you. That was really eye-opener. Thanks a lot.
Thank you.
Vinayak ji, can I ask?
Yes.
What is the rationale of including BEL in your 25 stock?
BEL?
Yeah, you're one of the
basically,
stocks in 20.
it's basically into defense. So
You mean Bharat Electronics?
yes,
Okay.
so it's into defense, it's into aerospace. So basically, I am bullish on the defense sector. I don't invest in PSU companies, but I'm investing into this or I.
This is PSU, right? BEL?
Yes. So
Okay.
this is the only PSU that I feel is okay because the sector is positive, the defense sector is positive. So that is the only reason why I am suggesting this one.
From electronics perspective,
Defense perspective, yes.
defense perspective. And JSW Energy from power point of view, power sector.
Yes, power point of view, yes.
Okay.
Hello, Vinayak.
Yes. Hi.
My question is actually related to one of the answers you gave. So, do you suggest that we should not invest if we are investing for long term, say 8 to 10 or more years into cyclical sectors?
Yeah, that is the important thing. Like I said, realty, media is an absolutely no for me, but realty is a cyclical sector. Metals is a cyclical sector. I would suggest absolutely no investing into cyclical sectors. If you look at, and again, you can search this post in the group. You can search the word cyclical in the group, and you might find a post that had made on the returns that metal stocks have given over the last 10, 12 years. And it's absolutely nothing. So cyclical sectors, the problem is they move up, and when the market falls, they come down significantly. So they're basically moving in a sideways fashion like this. We need stocks that move like this, not like this. And cyclical sectors move like this. So that is why I absolutely don't invest in cyclical sectors, because you need to time your investments in such kind of stocks. So when you're putting into stocks like Asian Paints, Bajaj Finance, DMart, ICICI Bank, Pidilite, Reliance, just to name a few, you can buy and hold. But if you're buying into a real estate stock or into a metal stock, you have to time this wave. Okay, so you have to put your money somewhere here, and you have to be able to exit somewhere here. And then again, you have to be able to buy somewhere here. So this is more of a buy and sell kind of a strategy, which is very difficult to execute because you need to be able to pinpoint, be able to pinpoint those points when the markets are turning. So I don't do that. I simply avoid cyclical sectors for investing.
One question that there are some companies like REC and PFC which finance power companies. So is it safe to like go for them for long term, or it's like a bit like risky, very risky, or not much return is expected from them?
These are government companies, right? These are government companies, huh?
Yeah.
PFC is Power Finance Corporation,
Yeah.
and REC is Rural Electrification.
All of them are PS.
Yeah. So like I said, I mean, if I have to go into energy, I'd rather go into, see, first thing is I always prefer private sector instead of public sector. And even in this portfolio, BEL was one because primarily of the defense factor. If I have to go into energy, I rather put it into Tata Power or JSW Energy or Borosil Renewables, these kind of companies that are private businesses that have the freedom to do what they want, and they have the capacity to grow. So when I look into investing, I don't go for, many people look for dividends. My perspective when I'm investing is to solely look at growth. I don't want to get 7-8% dividends from a stock. If I wanted that, I would invest in debt funds. But I want growth. I want 20, 25, 30, 40% returns. And that can come through private companies and companies that are allowed to, they have the freedom, they have the, expanding power. So even if, frankly, I've not studied PFC and REC in detail, so I don't mind acknowledging that at all. But I have not studied them simply because if I have to go into the energy sector, I'd rather put into a private company.
Vinayak, I have a question.
Yes.
We were talking about defense sectors. I have like two companies like M Defense and Aerospace, MTAR and Paras Defense. Actually, these are very volatile stocks, very, very volatile. So is it good for an investing point of view? Because fundamentals are quite fine. And what do you think about these two companies?
So if you have studied the fundamentals and if you are confident about the fundamentals, then this volatility might not matter, especially because I think they both recently had their IPOs, right? In 1 or 2 years. 1 or 2 years.
Correct.
So after, I mean, as it is, the markets have been volatile over the last 2 years. Plus, most of the IPOs that came, they came at an inflated price. So almost every single IPO is below, much below than what they actually started off at. So I think you should not. It's just been 1 or 2 years. Again, our time horizon is 10 years at least. So if you have confidence on the fundamentals, this volatility does not matter. If you look at the early early movements of the best stocks in the markets today, Bajaj Finance, or TCS, or any of the biggest stocks today, if you just go back to their charts and look at the price movement of these stocks when they actually, the IPOs came, they were very volatile then when they started off. So I think this is nothing to deter you from exiting these stocks as long as you're confident on the fundamentals.
Thank you.
Vinayak, I have one question on insurance sector.
Yes.
Yeah. What's your perspective on private insurance sectors like HDFC Life or SBI Life? What we see is the penetration of insurance in India is quite less. What I have studied. So, how do you see those sectors in another decade?
Right. So penetration is less, but one thing is that the competition is high. Competition is not less at all. So whether it's LIC or any of these other companies, competition is high. So they are all trying to capture that market share, and it's not easy. There is no sort of monopoly or what you call moat, which is, like you have a castle and you have water around it, so the others cannot enter. There's nothing like that in these stocks. So first thing is that. Secondly, insurance companies generally have a very low, they have a very low return on their revenues. So their profit margins are very small. You can go and study this also. The profit margins are small. So basically, for these two reasons, I don't prefer insurance companies as long-term investments, despite the fact that there is growth, a lot of growth. There's an equal amount of competition, plus their profit margins are less. So I personally don't prefer. I'm not saying they're bad stocks, but I feel that there are other sectors which can give much more rapid growth.
Okay, fine. Thanks, man.
Again, Vinayak. If someone select their own group of stocks, or as a matter of fact, they go on to follow the list of stocks you just mentioned, should they invest it in a SIP manner, or they just invest?
Your voice got cut towards the end. Hello. Okay, no problem. Let me just go ahead and look at some of the questions that have been posted in the chat.
Am I audible now?
Yeah, yes.
Yeah, so I was saying, if someone decides to follow your list of stocks for starting investing, or as a matter of fact, they go and select stocks on their own, should they invest in a systematic manner like SIPs per month basis, or just invest whenever they have cash in hand?
See, the thing is that when it comes to direct equity investing, the problem is the advantage mutual funds have over direct stocks is this simple thing that it's very difficult to be disciplined in your investing, because every stock has a different price, whereas in mutual fund that does not matter. So that is why I suggest that if somebody has problem being disciplined in investing in equities, then they should shift to mutual funds. But as far as this is concerned, there should be some kind of regular investment. It's impossible to do monthly SIPs, but at least every 3 to 6 months, you should keep adding some money into these stocks. So every month is absolutely impossible, but you can create a pool of cash or capital every 3 to 6 months. And every 3 to 6 months, you can buy these stocks. So basically you can have around, let's say 2 to 4 investing cycles every year, and you can keep investing in these stocks in those cycles.
Okay, got it.
Yeah.
Vinayak, I have one question regarding this timing. As you said, we should not timing the market. See, there was some stocks like Tata Elxsi. It was went up to 11,000.
Yes.
But I was holding this stock for a long time, and I did not sold because people are telling this stock has a long future. It will go further away. Right. But now this has come down to 6,000. So had I sold at 11,000, I could have earned the, what is the difference now? Now it is gone to 6,000.
Right.
So and this stock has given 3-4 times like this opportunity. So means like means my concern is, if we see that if we get a good profit, why can't we just simply exit and then wait for till it fall down?
Again, that is purely, see, when the stock was at 11,000.
Yeah.
But you're thinking now, you might not have thought about it at that point in time, or maybe you wouldn't have been that you wouldn't have had that conviction. So basically, when a stock is moving up, it's very difficult to sell.
Yeah, correct, right. Yes.
Profit. You don't want to remove that stock. But when it falls, everybody, in retrospect, everybody can see, oh, I should have sold. So it sounds good theoretically, but practically it's impossible to do consistently. Right now, you see that yes, you should have sold, but when a stock is rising, it's very, very hard for anybody to sell because you're making a profit. Why would you want to sell? And when it starts to drop, even when somebody trades, I've seen this so much because I've taught so many people. If a stock they've bought at 100, if it comes down to 95, they will not sell. They will wait for it to come back to the cost price. That is one of the common aspects that I've seen with every trader. They will wait for it to come to the cost price. Then if it goes down to 90, they'll add more stocks. I'm absolutely guaranteeing everybody here must have 1 or 2 stocks in their portfolio, maybe more, that they bought. It fell down. They did not exit at 5, 6, 7%. And now it is in 10, 15, 20, 30, 40% in red. So it's very difficult to sell, number one, when the stock is going up. Number two, when it starts to come down a bit, it's even more difficult to sell because you don't want to book a loss. You don't want to have that feeling of taking a hard decision and actually booking a loss on a stock. However, in this case, you did not actually have a loss, but I'm just saying that. So basically, these things get very, easy to say in retrospect, but when you actually come down to doing it now, it's very difficult to implement. That is why unless a company's fundamentals change, the stock should not be exited.
So is it right time to add this stock now just to cover that loss?
I would not add right now. Simple reason being, there's a clear sign of see, Indian IT stocks get affected by NASDAQ, and the US market is negative. There's an impending recession, so it's not logical to add any money into IT stocks as of now.
Yes.
Okay. Thanks. Yeah.
And one more thing, like, I mean, as to just an addition to it.
Yes.
I was a Galaxy employee, and then as a company,
yes,
it has basically into the automotive now the game platform for the automotive EVs to basically, and then they are into AI. So as a fundamental wise, as I know companies, it's pretty good. And even as I'm holding from the top itself. So we can for some more time and then average it when is as a company wise it's fine. It's going to go good actually. So not worry.
Right. Great.
Okay. Thanks. Yeah.
Thank you. Yeah. Any other questions?
Vinayak, do you have any view about IRCTC? You want to say anything about it? Because the stock has been in their ups and downs and so many things are going on. Could you highlight something about it?
I mean, it's a good company. It's kind of a monopoly. So again, it went up so quickly. I don't exactly remember when, but sometime back it went up very, very quickly and then it started to come down. So I think, see, every stock that moves up has to enter into a phase of consolidation or into a phase of some sort of a downturn. I don't think it's a bad long-term investment at all if you are holding it. I mean, the most important thing is that it is kind of a monopoly, and the way the government is focusing on railways, there's a lot of prospects for IRCTC in the future. So I think it's definitely in the end we have to look at some sort of a risk reward kind of we have to do that kind of an analysis. So if you ask about IRCTC, I would say that the reward is slightly, maybe not slightly, but quite a lot in favor of putting money into the stock than in terms of the risk. So I think it's a good long-term investment. I don't feel there's any problem with it, specifically given the fact that it's, like I said, it's sort of a monopoly, plus the government's focus on railways is very, very huge. So both these factors combined, the sector is growing, plus there is no real competitor. So I don't think there's any reason to not buy this stock. even if you have it, you should keep it. But again, time horizon should be long, and I think you'll definitely make good money in the stock.
Okay, thank you.
Yeah, thank you.
Vinay, Sudhakar here.
Yes.
I have a couple of stocks, or rather more than 5 to 10 stocks in the list, whatever you suggest of 25. Okay.
Right.
But all of them, mostly I have bought at the peak period. Okay. By now it's around 15 to 20% down. I prefer to definitely hold it for more than 5 to 8 years time while I was thought of investing in those stocks. But now it has gone down by 20%. Is it worth to wait for some more time for averaging, or can we start doing something add on to the stocks?
Okay, so actually, when we talk about averaging, the thing is that many people try to do investing on the basis of technicals. So they look at charts and they'll look at, they'll want to invest in a particular stock. So firstly, investing should always be done on the basis of fundamentals. That is what you've done. You've identified a business and then you've put money into it. But when to add more is something that technicals can help a lot in, because a stock might come down and then it might be taking support and at certain significant levels. And you know that, okay, it has come down to a very important level, and from here it might move up. And that is a point at which you can make some entries. So firstly is, if somebody knows how to learn, if somebody knows how to understand technicals, they can use those to make entries. But secondly, I would still suggest that you might wait. Again, I might be completely wrong here, and I hope I'm wrong, that there's no major recession. But if there is, that could be the exact point to invest. So I would suggest, if you have limited cash and you cannot distribute it over 1 year to 18 months, it's better to wait 3-4 months and then start investing. But if you can distribute this cash, if you have that much, and if you can distribute it over the next 12 to 18 months, then you can start putting into the stocks from right now.
Okay, thank you.
Okay, so somebody asked me about disinvestments. I see disinvestment is a very small aspect. It's like, I look at the business, and disinvestment is not something that can turn around the business, I don't feel, in the sense that, I don't invest on the basis of such news. Firstly, these are news. When they affect the stock, how much they affect the stock, how much has actually been factored into the stock, is something we don't know about. So I don't buy stocks only on the basis of the possibility of a disinvestment. That is a short-term bet. I simply look at the business. So that is why I simply go for, like I said, private companies. PSUs, very rarely do I go for PSUs, but I don't use disinvestment as a reason to invest for the long term. Okay, so somebody asked me, can this list be brought down to 10 to 12 stock? It's very hard to do that, actually. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. I would say 15. Yeah, you can use these 15 stocks: Adani, Asian Paints, Bajaj Finance, ICICI Bank, Pidilite, Reliance, SBI, Sun Pharma, TCS, Ultratech, SRF, SBI Cards, Ambuja Cement, HAL, and JSW Energy. So 15 stocks, but I would still suggest you keep it at least 20 stocks. That ensures proper diversification. Okay, PSU banks, for long term, they seem okay. Power companies, PSU power companies, I don't invest in them, but PSU banks look good for exclusively the long term. However, they've rallied quite significantly. So I had posted in the group some days back also that they will see a correction, and they have been coming down now. So I would suggest to not add into those stocks at the moment. Wait a bit and you might find better opportunities. But I think for the long term, they're not a bad bet. But the problem here is in selecting the PSU banks. Okay, so there is always the risk that there might be some old corruption thing that might come out later on, and that is why selecting a specific PSU bank or 2-3 becomes a difficult task. And that is why I suggested long back that put it into the PSU ETF, and that went up quite significantly from 230 to about 450 or something.
Hello, I think so. In ICICI Bank, Chanda Kochar arrest will have an effect, a lot of effect.
Okay, I was in the middle of an answer, but fine. So like I was saying that, PSU banks, if you want to invest, you can go for the ETFs because they distribute the capital over all the PSU banks, and that reduces the risk and the effort to select a particular stock. So you don't have to take that risk of picking up, PSU banks and, running the risk of these stocks, coming out with some scam or something like that later on. So if you want to invest in PSU banks, go for an ETF. I think SBI has one, Kotak has one, but they're absolutely the same constituents, and the percentage of investment is absolutely the same. So you can pick any of those two. And in this particular ETF, you might want to sort of invest a little bit every single month. So if you want to invest, let's say 50,000 into the PSU banks, to start putting 5,000 each for the next few months. So that is, in such an ETF, you can create some sort of an SIP kind of a thing. Okay, so gold, I don't invest in gold, and I would suggest it's not appropriate to invest in gold either. It's not a asset that gives good return. It's very ordinary returns. So I think if you're in the markets, it's better to put it into assets that can give you returns, that can give you growth. And gold is, people buy it because they believe that it's a hedge against inflation, but in the long term, equities are a much better hedge against inflation. So in the short term, REITs are the best hedge against inflation. In the long term, equities. So gold is a no for me. There's no use in investing in gold. IDFC First Bank, I think it's a very good stock for the long term. One of the rare companies, banking stocks, that can move up in the long term. How to exit a stock technically, I cannot explain that. That's completely a technical thing. It's impossible for me to sort of teach technicals here. Yeah. Any other questions? When can you average IT stocks? Wait some time, wait 2-3 months, the market might go down, then start averaging. But always remember, don't time the markets. And what would timing the markets be? You collect some cash today and you put it all into the markets in a single month. Don't do that. I'm saying it again and again. Even if you have to sell some stocks from your portfolio, sell them, the bad ones, let's say. Don't mind booking losses. It's not like I've never booked losses. I've booked losses. But see, the most important thing is when you don't book a loss, your loss increases. And secondly, the capital that you have in the stock, that's dead capital. So if you've invested 10,000 rupees in a stock and the stock has come down to 7,000 rupees, the value of the stock has come down to 7,000. If you just stick to it like that and it stays there for 2 years, if only you could have exited at a loss of 3,000 and put that 7,000 into the bank, at least you would have gotten a 7% return on that. So when you don't book losses in a bad stock, in a bad trade or investment, what you're essentially doing is you're not only increasing your losses, but especially looking at the scenario, global scenario in the coming 2 years, you're not only increasing the potential for, even exaggerated losses, but you're also collecting debt capital, which is not even giving you a basic return that a bank would give. So, it's important to sort of collect the cash whichever way you can. And then if you are able to distribute it over the next, like I said, 12 to 18 months. So don't time the markets. Even I'm not going to time the markets. I cannot, nobody can. So the best thing is, see, what you can do is maybe put more money when you feel that the market is rebounding, or when you see that the market is rebounding. That's a different thing. But you cannot wait for that opportunity because you might most likely miss it. So start putting money maybe from 2-3 months time on from here. Start putting some money every single month. And then if you feel that, okay, the market might have finally bottomed out 6 months, 8 months, 2 years, whatever period from now, at that particular bottom, you might put in more, but it's very important to distribute the capital over the next 12 to 18 months. As far as sugar sector is concerned, I don't invest into sugar and sectors. You can see the charts. They don't give any long-term returns. That's a pure trading sector. So see, when you're talking about investing now, it's not about knowing what you have to invest in, but it's more about knowing what you should avoid. So like I said, media, realty, metals, I avoid these. Sugar sector, I avoid airlines stocks. I know what I have to avoid. So just by thinking in that fashion, I completely eliminate a large pool of stocks, and then I come down to significant, a very smaller pool of stocks from which I can select. So sugar sector is okay for trading. It's not for long-term investing. I personally feel, I might be wrong, but I don't invest in that. Where do I see the markets 10 years from now? Like I had just shown in this particular slide, at a rate of 12% growth at 55,000. This is nothing special or nothing extraordinary. Nifty has historically given 11 to 12% return. Despite a recession, it might still end up giving on an average 12% return over the next years. So you might definitely see Nifty 50,000 plus in the next 10 years. ITC, I don't invest in ITC. Can anybody sort of guess why I don't invest in ITC?
High risk, because anytime the government could come up with something to ban cigarettes or something like that, and almost 30-40% of their revenue comes from cigarettes.
Yeah, so one reason is definitely that.
And one reason I would say that ITC was stuck at a particular place for a long time, which is very unusual for FMCG company.
Yeah, okay, that's true. Something else that
it can be this also, that ITC actually is a combination of multiple businesses. So correctly valuating that particular stock is difficult because it has many businesses: cigarettes, hotels, FMCGs, etc.
Yes, that's another reason. Something else.
Higher dividend.
Yeah, that's correct. But why high dividend will deter me from investing in the stock?
That it stops the growth of the company.
Yes. So it's very simple. If you own a business today, and if you make 1 lakh rupees every month, and you distribute that into the family, you're basically, just consider your family as shareholders. You're distributing your profits into your family. What you're doing is you're not putting it back into the business. ITC is a similar kind of a stock. If it's giving out dividends, it is accepting on its own that it does not see growth in its own business. Why would I invest in a company that is itself accepting in an indirect way that it has no growth, which is why its stock has been stuck for so long? Any company that has seen genuine growth will grow. So I don't invest in dividend stocks because of this reason. Because if they're giving out money, they actually don't have capital, or they don't see the vision. They don't have the vision, or maybe they have the vision, but they simply don't see the prospects for growth. So if the people who know the company best are telling you that, look, I don't have money to put into my business, that is why I'm giving it to you. So do whatever you want to do with it. So why would I put my money into it? If you want to put money into ITC with dividends, that's fine. But like I said before also, 6, 7, 8, 10% maybe maximum. Generally companies don't give higher than that. आपको 8-10% चाहिए तो उतना तो आपको डेट फंड से भी मिल जाएगा, 7-8% के आसपास मिल जाएगा. Plus you are accepting the volatility that comes with the stock, with all these dividend stocks. So if a dividend stock falls, let's say 20-30%, the dividend will not be able to compensate for that capital loss. So you're actually, in the end, you might not be making any significant money. So it's better if you, like I said, choose debt or choose growth stocks. Don't fall in between and choose dividend stocks. This is like buying an LIC policy or a ULIP or something like that, where you want some investment and you want some insurance. It works neither way. So if you want insurance, go for a term plan. If you want investments, put it into the markets. So similarly, I don't go for dividend stocks.
With a similar aspect, how do you evaluate Vedanta?
I have not analyzed the company, frankly, a lot.
Because that company is also giving a very good dividend, but seems the business prospects are good, being into the mining.
I don't think it has given much return in the past. Has it?
No, it is not written.
Oh,
it has not given
given a dividend of 25% plus in this year.
It's a dividend stock, pure dividend stock.
Yeah. So see, 1 year 25% is exceptional. You cannot use that as a constant. मतलब उसको आप लेके नहीं चल सकती कि भाई हर साल मुझे यही मिलेगा. 25% dividend is very, very exceptional. You will not get that in a longer time frame. See, since 1994, if I just do a very simple calculation, मतलब इसमें कोई bonus वो सब मैंने कुछ utilize नहीं करा है. The stock is from 1994. That's how many 26, 28 years, let's say. It's moved from around 11 rupees to current value of 285. So it's given you a return of 12%. So why would I put my money into a stock that has given me 12% return over 12% annual return over a period of 28 years? Plus, if anybody looks at the chart of the stock, okay, I'll just show you the chart. Wait a minute. Where is the screen sharing tool? Yeah. Can you see the screen now?
Nope.
Nobody?
Yeah, we can see.
Yeah, we can see.
Okay, so from here till here, it's 12%, but the entire return was actually from 2002 to 2010. So in this 8 years, it gave a return. But if you look at the last 12 years, it has absolutely done nothing. So, I mean, it's not there must be some reason why the stock isn't moving. So I don't think.
No, there was some ban for mining for a very long period in between.
Okay, so why enter into a stock that can suffer from government regulations?
Sterlite case?
Yes, it is the same.
Yeah, it was Sterlite.
Yeah. So again, why enter into stocks that can have direct interventions or direct problems? Mining is a very मतलब ऐसा सेक्टर है जो आप फ्रीली नहीं कर सकते. आपको कुछ ना कुछ restrictions, कुछ ना कुछ तो होगा ही आपके ऊपर. If you want to sell honey today, you can do it much easier than sort of boring through a mountain. So why would I look to enter into stocks that have a great possibility of government interventions, state governments also, central government also? So I mean, I just completely avoid these kind of stocks. There's so many stocks to put into. That is why I say just select sectors first. Look at simple sectors that you can understand. Don't go for sectors that are complicated.
So Vinayak, you said that you avoid dividend stocks.
Yes.
So my question is that a company which is giving dividends, you said that they just share the profit among family. So is this the only reason why a company give reasons to?
Yeah, but basically, see, sometimes even large cap companies, even other companies give dividends, but they're very small dividends. So if they have some profit left over, they'll share it among their shareholders. I'm talking about companies that are pure dividend stocks that have a history of continuously sharing their dividends with investors. And yes, that is the primary reason. If they have growth in their businesses, they will not share the dividends because they need to put money into their businesses. It's absolutely illogical. If a company finds that, yes, I have growth potential in my business, it will not give away its profits to its shareholders and then take a loan to put it into its business. That is against all logic. So what it'll do is it'll not give those dividends. Instead, it'll put that money into its business. That money will move into the business. It'll expand the business will grow, and that will lead to a rise in the stock price. So in that fashion, they're sort of indirectly giving a benefit to their shareholders. Dividends में कि directly आपको benefit मिलता है. बैंक अकाउंट में पैसा आता है तो लोगों को लगता है बहुत अच्छा लगता है कि यार पैसे हमारे बैंक अकाउंट में आ गए. लेकिन that is not as fruitful. उसके पीछे रीजन एक और ये है कि जब आपके बैंक अकाउंट में आते हैं, ऐसे कितने लोग हैं जिनको डिविडेंड मिलता है और वापस मार्केट में डालते हैं? बहुत कम होंगे. I feel there must be very few people. So what you're doing is basically you're not, see, real investing is putting more money into the markets. So once they've given you a dividend, very, very few people will put that back into the markets. They'll use it somewhere else. So you're not utilizing that capital as best as you can. अगर आप उसको बैंक में डाल दोगे आपको 7% मिलेगा, लेकिन वही कैपिटल अगर कंपनी अपने बिजनेस में लगा देगी और उसका बिजनेस 20% से ग्रो करेगा तो आपको शेयर पे भी 20% का रिटर्न मिलेगा. तो जो कैपिटल आपको 6-7% बैंक में दे रहा है वो कंपनी खुद इन्वेस्ट करके 20% दे सकती है आपको. इसलिए आई सिंपली डोंट गो फॉर डिविडेंड स्टॉक्स.
Great, thanks, Vinayak.
Any other questions? Okay, fine. So let me open the chat once. Fundamental analysis, I'm actually looking to first create a small course on how to manage your portfolio, in the sense that all of you must have portfolios, right? Now, buying a new stock is something different, but getting the right diversification in your current portfolio is more important, because especially looking at the next few months or maybe 1 or 2 years, it's very important to sort of manage the risk that you currently have in your portfolio. So I was thinking about, and I've started working a little bit also, to create a small short course on what types of investing there are, and what are the basic things that you can follow with respect to diversification and how to manage your portfolio. So if you'd be interested, I can work more on that.
I think so. One version that PSU companies respect high dividend PSU companies respect support and resistance a lot because of that.
I don't know. I don't know about that.
Because growth is very limited, so doing something extraordinary, then it would take something more extraordinary.
The dividend paid out by them is only to the government. It is never to the shareholders, the retailers. Retailers constitute very small quantity of that. I may be wrong, Vinayak, but that's what I have understood. Like government, because the government is the major holder of PSC and PSUs.
Yes, right. Absolutely. So, yeah, like I was saying, that I'm creating a short course on portfolio management. So if you'd be interested, I can work on that. Very short course, basically about financial literacy only. So at least you'll get an idea of how to diversify, what to, it's not about financial, मतलब fundamental analysis नहीं है उसमें कि आपको stocks कैसे pick करने हैं, but some things that you can avoid, some things that you can keep in mind, how to diversify your portfolio, what to include, what not to include, these kind of things. तो आपको एक basic अपना framework मिलेगा portfolio का, तभी आप, उसमें एक अच्छा portfolio create कर सकते हैं. Because see, stock picking again is a different aspect. Like I said, I gave an example of somebody, he'd bought 40% Burger King. Now, कितना भी अच्छा स्टॉक हो, 40% स्टॉक का नहीं होना चाहिए पोर्टफोलियो में, कोई भी हो, सिंपल सी बात. तो अगर वो बर्गर किंग ऊपर भी चले जाता, he would have gained a lot of money, but that would have been a false, I wouldn't say false, but maybe it's a wrong method of investing, because you cannot put 40% into a single stock, कितना भी अच्छा क्यों ना हो. So when people forget or don't know about these basic aspects of investing and portfolio management, and nobody's teaching this, because I've done CFA, I've learned this directly. So I know what aspects one needs to keep in mind to manage portfolios. So if you keep these things in mind, you can automatically start creating better portfolios. Your stocks will fit into the portfolio that you're creating. But if you don't know these aspects, you will completely falter. And even through selecting good companies, let's say you have 10 companies in your portfolio, you put, let's say 5% in 9 companies, 9 5s are 45. Let's say 50%, you just put 50% of your portfolio in 9 companies, and in the 10th company you put the rest 50%. Now all these 9 companies are very good companies, top companies, they give you a lot of growth. But that one company that you've put 50% into, that is the one wrong selection for you, and that stock comes down. There is no way that the rest of the 9 companies can cover up for the loss you're going to make in that one single company. So the problem here is not of stock selection. You have a 9:10 or 90% success rate or 90% correct, method of selecting stocks. The problem is basic aspect of portfolio creation. So that is more important than actually selecting companies. Companies to आप बाद में select धीरे-धीरे कर सकते हो. And like I just gave you the portfolio that I shared with you, it's not done on any in-depth fundamental analysis. Common sense है. Asian Paints है, Reliance है, SBI है, ICICI बैंक है, L&T है, BEL है, HAL है. कॉमन सेंस के बेसिस पे लिया है, कोई बैठकर घंटों तक उसको एनालाइज नहीं करा है मैंने. सो you can use common sense to invest, but you need to know how much to put into a particular stock. That is more important. Similarly, in trading, what people do is they'll put a lot of their capital in a single trade, and that one single trade falls down, that one single stock goes down 20%, and then they've suddenly lost 10% of the capital in a single trade. उसको डाइवर्सिफाई करते तो उनका उतना लॉस ना होता. तो बेसिक फाइनेंशियल एजुकेशन ही इतनी कम है, which is not anybody's fault here. It's simply that this is not taught. And that is what I'm trying to do through this session also. I'm trying to simply educate. उससे ज़्यादा मेरा कोई मोटिव नहीं है कि अगर लोगों तक प्रॉपर एजुकेशन भी पहुंच जाए तो they can, once they start thinking right, they will start acting right.
Sure, thanks, Vinayak.
Okay, so we'll close the session. How was the session?
Thank you, Vinayak. It was nice.
Fantastic. Thank you.
Nice, sir.
Yeah.
It's nice, Vinayak. Thank you.
Good presentation.
Thank you.
Vinayak, just one small question. Would you be handling or would you be assisting some of us who are interested with any portfolio management like that? Would your guidance be there?
It's exclusively for mutual funds.
Okay, not on stock markets.
Not on stock markets, because
okay,
it's very difficult to manage that for me. And I am not SEBI registered, so I cannot take any fees from anybody. And so, I'm not somebody who, even if I take fees from somebody, it won't matter because SEBI is, involved in much bigger things. So it won't matter that 5-10,000, 1 lakh, 5 lakh रुपए इधर उधर होते हैं. But that is not my nature to, sort of get into all that. So I simply go for mutual fund investing. बाकी stocks में किसी को advice चाहिए होती है तो वो मैं कर देता हूँ, but I don't professionally do it.
Okay, thanks, Vinayak.
Vinayak, one last question. What's your perspective on Nifty 50 and Nifty Next 50 as an mutual fund investment?
Okay, so basically, investing into Nifty is a way of simply investing into an index fund kind of a thing. So आप basically Nifty के stocks को buy कर रहे हो. So I mean, it's good if you want to be a defensive investor, if you don't have the time to analyze your stocks and manage your stocks and what to buy, what not to buy, then you can sort of go into these aspects. It's definitely a good investment as long as you are, that you don't have the knowledge to select stocks and don't have the time to balance your portfolio. So for that purpose, index funds, I would suggest they're very good. They give you 10 to 12% returns, consistent returns, safe returns in terms of the relatively safe returns in terms of the market. So that's a very good investment. Again, like I said, if you don't have the time to look into stocks. So in that perspective, it's good. At least it gives you a start into the markets. So if you just want to start, if you're nervous about entering into the markets and you want to sort of, you just want to touch the water to see how cold it is, that kind of a thing. So if you want to do something like that, for that purpose, it's very good. You can keep it you can keep it going on also. So defensive investors के लिए अच्छा है, जिनको volatility नहीं चाहिए.
Okay. Vinayak, this is one of the best investment class which I heard from you. Best of best. I have been hearing to your class from almost 2 years, close to 2 years, but this is the best I have heard.
Thank you.
Even in outside also, I have seen some of the professors and lecturers are teaching in colleges, even during our college days also. But I have never heard of such a sensible class from long time, from 20 years of my education. That's exactly.
Thank you.
Thank you.
Okay, great.
Would you mind sharing a recording of this session in your group, Vinayak ji?
Yeah, I'll share the recording in the group, no problem.
Thank you.
Yeah.
Vinayak ji, sorry, I'm very late, but one small question. What do you suggest about ETFs in case somebody wants to invest?
Like I said, I have personally invested in PSU ETFs, PSU Bank ETF. See, as far as investing is concerned, and this is something which is common to ETFs and mutual funds, don't invest in sectoral ETFs or mutual funds. PSU banks is something very different. That's not a sector. That is in the sense that it's not cyclical, basically. PSU banks is not cyclical. People buy mutual funds, they'll buy real estate mutual funds, media, I don't know what kind of mutual funds. So whether it's ETFs or mutual funds, don't buy sectoral mutual funds. As far as ETFs go, I've bought PSU ETFs, PSU bank ETFs, simply because I want exposure to this sector, but I don't want to go through the process of selecting individual PSU banks, 2-3 PSU banks, because if you actually look into these PSU banks, there's so many, and you cannot buy 7-8 of them. If you buy 7-8 PSU banks, if your portfolio has 25 stocks, you should not have more than 25-30 stocks in your portfolio. But if you have 25 stocks, if you buy 7-8 PSU banks, already you've put 1/4 of your the 1/4 of your stocks are into PSU stocks. So if you have to bring it down to 2-3, it becomes a very difficult task. And for example, if even one of them turns out to be a problematic investment in the long term, then your entire investment into this sector becomes a trouble for your portfolio. So PSU is something different. I would suggest you can invest, but look for an ETF in that particular case. But otherwise, if you find ETFs that are sector specific, I would suggest you do not invest in those. It's better to go for diversified ETFs or mutual funds.
Thank you so much.
Okay, so
thank you so much, Vinayak. It was actually a great session for me and my wife. Both of us were attending it. Thank you so much for your time.
Thank you. Yeah. Would anybody else like to say anything?
Thank you, Vinayak. One of the wonderful sessions what we have had with you all these months now that we know, and wonderful in-depth knowledge that you have shared with us today, with a beautiful curated portfolio, I would say, be it a defensive or aggressive, but a wonderful portfolio, because this is what people need to know where to invest.
Exactly.
Instead of just picking up randomly over the tips, over the social media.
Yes, exactly. Absolutely.
Yeah. Thank you so much. God bless. Thanks. Good night.
Good night. In the future, I will come up with courses on fundamental analysis also. It will take some time, but I'll do that as well. Right now, I'm focusing on technicals. In the
Waiting
future,
for Feb options.
Yes, absolutely.
Sometimes, Vinayak ji,
Yes.
sometimes I wonder, why don't you consider gold as an investment vis-a-vis shares?
See, like I said, returns are very low.
Okay.
Returns are extremely low. Plus, it's not like gold does not have volatility. It is volatile. So, gold, I think historically has given about 6-7% return. So if you want to get 6-7% return, it's better to go for a government bond, which will give you 7-8% return. So you don't have volatility, plus you have government of India ka bond hai, to aapko safety hai. If that defaults, then nothing is left. So there's stability of returns, plus there is no volatility. The gold is actually, it's a very, very defensive, and I would say it's the old mindset investment.
Okay.
But that is why I prefer stocks completely. For example, Reliance, it's historically given 17-18% return. Even in the worst case, I would say, अगर वो 10% भी मुझे अगले 10 साल में देता है, तो फिर भी गोल्ड से ज्यादा दे रहा है. इसलिए मैं stocks की तरफ ही जाता हूं.
Sometimes it is good hedging tool against any calamity or crisis, like in COVID.
So that could be the case, but I mean, just वो आपको फिर बिल्कुल टाइम करना पड़ता है.
हाँ.
ठीक है, आप गिरने वाला आप गोल्ड खरीद के बैठ जाओ, फिर देन द क्वांटिटी आल्सो मैटर्स. अगर आप 5-10% पोर्टफोलियो का कितनी देगा नहीं, तो you have to buy at least 30-40% of your portfolio's worth of gold to provide some kind of hedging. And sometimes even in crashes, commodities fall. So it's not 100% कि market गिरेगा, economy नीचे जाएगी तो gold ऊपर ही ऊपर जाएगा. I'll share an example also later on, but ऐसा 100% नहीं होता. तो that is why I don't consider gold as an investment.
The way the international scenario is going on, this Russia-Ukraine will not be so easily specified situation.
Right.
The way US has entered indirectly, something might happen in the next 30 days.
Yes. See, I have, I'll just share the I'll share one thing before the session. Okay, so this is gold chart, and I don't know what gold it is, but I just opened it. So this is 2020. It rose during the COVID times, but then it has started falling. See, the basic thing is that if we are looking at gold as a hedge against market falls, it's very important to understand that in the markets, bull markets run longer than bear markets. So if I am going to invest in gold, I am putting it into an asset that is going to move up for a shorter period of time. अगर 10 साल का bull market होगा तो 2 साल का bear market होगा. तो मैं पैसा सिर्फ 2 साल के लिए डाल रहा हूँ, मैं 10 साल का पर्सपेक्टिव को नहीं देख रहा हूँ. तो I want to put it into an asset which will move up majority of the time instead of just for a short period of time. इसलिए प्लस रिटर्न्स भी ऐसे कोई एक्सेप्शनल नहीं होते हैं अगर आप लॉन्ग, तो इसलिए I don't consider gold.
Basically, your perspective in most of the lectures is a long-term perspective.
Yes, for this is it's purely long term. जो मैंने आज बोला है purely long term. Yes.
So the title Wealth Wagon justifies your
yes
vichar. It should be in vegan, not peaceful.
Okay. If anybody else would like to say something before we close.
Thank you.
Vinayakji, the session that you wanted to schedule for us later, will that be a single session, or I mean the course, or will it be spread into 3-4 modules covering all of these aspects that you mentioned in depth again later?
The portfolio management one?
No, you said if we are interested, you would schedule.
Yes, that one. Yes. No,
So
basically,
is it the portfolio management course only?
yes, that one. Yes. So what I'll do in that is I'll basically record these sessions, and then I'll share the recordings, and you can study it in your own time. And then later on, after the course, after I've shared all the recordings, I'll conduct live sessions to solve doubts.
Okay.
That's better. We have the perspective before asking you.
Yes.
Thank you, Vinayakji. So please do share the details of the course.
Yeah, I'm still constructing it. Once it's done, I'll share.
Okay, thank you.
Okay.
Vinayak, one thought. You're putting in your time for all these things, right? So you can have some minimal fees also from us, no issues, because your time is going in here, right? So I'm just a thought process.
You're talking about the fees, right?
Yeah, that's true. Because see, a lot of knowledge gained by us, or a lot of stocks recommendation done for last few months. We could able to earn some out of your stocks recommendation. So, I mean, even if you have some minimal charges for this, so also it's fine for us. That's what I'm saying. Yeah.
Yeah. So these sessions that I'm conducting, I don't want to charge for these particular sessions because at least, you know, everybody deserves to have at least some basic knowledge. So I know that, you know, if I charge 100, 200, 300, 500 rupees, it does not matter to me and neither does it matter to you. But still, some people feel, yeah, why to pay agar free hai to? Some people have that thought. So these sessions, I just keep them for free. But yeah, my nature is definitely not that kind of a, you know, my thought is not of giving freebies to anybody, because of one, it undermines my effort and my knowledge. Secondly, it undermines you also, because अगर मैं आपसे बोल रहा हूँ 500 रुपए दो, तो अगर मैं वो नहीं चार्ज कर रहा हूँ तो मैं क्या मेरे दिमाग में है कि आपकी उतनी आप you cannot even pay 500 rupees. So I mean, and third most importantly, if somebody puts a little money into something, they value it more. Free stuff को कोई value नहीं करता. अगर आप 100 रुपए भी डालोगे तो आपको लगेगा कि नहीं यार इसमें पैसा डाला है, एक बार देख तो लो क्या है. So you also put more effort into it. So these sessions, like I said, these are very basic sessions that I'm taking. So these I did not want to charge because लोग कुछ भी हो छोटे पैसे से भी कभी-कभी डिस्करेज हो जाते हैं, तो मैंने कहा कोई प्रॉब्लम नहीं है. बट जो कोर्स की मैं बात कर रहा हूँ, that I'll keep at a minimal charge. That I'll keep at a minimal charge. Yeah.
It's okay. Yeah. I just
overall, I appreciate your generous nature in this, that too in the stock analysis. Very few persons have as hearty nature as you have.
Thank you.
And that too on the professional level you are talking, not just filling up the sentences.
Yeah, thank you. Thank you. Yeah. So If, I'll share the recording in the group itself, in the main groups, and please share this recording with others also, everybody that you know. So you know, ये चीज कोई नहीं सिखाता, because ये fascinating चीजें नहीं है, मतलब मैं आपको बता रहा हूँ मेंटली कैसे मार्केट में एक्ट करो, क्या होना चाहिए, क्या कैसे सोचो, कैसे मत सोचो. पीपल डोंट फील दिस एज फैसिनेटिंग. लेकिन आज मैं आपको बोलूंगा, मैं आपको पेनी स्टॉक बताता हूँ, 1 महीने में आपका डबल हो जाएगा पैसे, तो सब आ जाएंगे. तो ये एस्पेक्ट्स उतने इंटरेस्टिंग नहीं है, बट यही जरूरी है. इफ पीपल कैन फॉलो दीज थिंग्स, देन ओनली दे विल सक्सीड इन द मार्केट्स. सो वॉरेन बफेट, इफ बिफोर क्लोजिंग आई गिव अ सिंपल एग्जांपल, इन द 2000 IT bubble, everybody was making money. Their portfolios were doubling, becoming triple in 2-3 months. Hedge funds, mutual funds, everybody was making a lot of money, and they were all making fun of Warren Buffett, saying that he's a fool and he's lost his touch and he's become old, and he did not put a single money into the IT stocks. And then everything came crashing down. Everybody went out of the markets, and he's still here. So it wasn't about analysis, it was about mental discipline. कि मुझे नहीं डालना मतलब नहीं डालना. सब इस पीछे भाग रहे हैं, मुझे पैसा नहीं डालना, सिंपल सी बात है, चाहे लोग मुझे कुछ भी कहें. अदरवाइज इफ वी वर इन दिस पोजीशन, जस्ट दैट मेंटल प्रेशर, मीडिया प्रेशर, हम सोचते चलो थोड़ा पैसा तो डाल दो यार, इतना पैसा पड़ा है, क्या फर्क पड़ेगा. But he did not. So it's market success, like I said, it's 70-80% mental discipline, 20-30% analysis. लोग सिर्फ 20-30% पे फोकस करते हैं, ये 70-80% को भूल जाते हैं. कुछ होता है. तो whatever I'm teaching, please share these things with others also. मतलब जो ग्रुप में नहीं भी है, आप प्लीज मेरे ग्रुप का लिंक भी शेयर करिए और लोगों के साथ, तो दे विल ऑल्सो ज्वाइन. एंड वीडियो का लिंक भी शेयर करूंगा, तो वो भी आप प्लीज और लोगों के साथ शेयर करिएगा. Okay.
Sure, we'll do that.
If I'm allowed to speak on behalf of all participants, let God empower you more so that we may get proper knowledge.
Indeed, indeed. I always tell Vinayak that.
Yeah,
God bless you.
Thank you.
You have long life to live and to help us all.
Thank you.
Thanks. Good night. Bye.
Like family here taking care of the family, you are taking care of us.
Yeah. No, but plus, you know, he's dedicatedly doing it for us.
Yes.
So
correct,
young,
correct.
and yet he's doing it, Salish. Just, I mean, you know, not even taking money for that, paying what he takes for us.
Correct.
Yep.
Correct.
That's true.
Apart from money, his sincerity is displayed.
Yeah, it's sincerity. And that's what his first thing is, that I want to make sure that everybody is financially literate.
Yes, and that is a single goal we don't hear from any people.
Sir, I've attended, I told Vinayak personally one-to-one, I've attended so many, all these paid classes of big TV panelists.
Yes.
Believe me, it's all humbug. Nothing but just a pure money fleecing racket.
What is your good name, sir?
I'm Dinesh.
Okay. That is very true.
Yeah. So we stopped. And now I'm with Vinayak for almost like what, 2 years, Vinayak?
Yes.
From your first class, what you started.
Yes.
Every single I have attended.
Yes.
God give you more power, Vinayak. Thank you so much, and God bless you. Good night.
Good night.
Good night.
Thank you all. Bye.
Thanks, Vinayak. It was a nice session. Thank you very much.
Good night, everyone. So I'll share the link, and you can watch it again. You can look through the portfolio again, and please share this with others also. And also please invite more people to the groups that I have. And before, I know only few people are remaining now, but I'll just like to share one thing. If you feel like somebody said that, you know, I should have charged a fee for this, whatever fee you feel that I should have charged for this, just whatever, 100 rupees, 500 rupees, whatever it is you feel, please donate it to the website link I've just mentioned in the chat. Whatever you feel was appropriate for this session today, just please put that money into this particular website.
That's a very good initiative that you've taken, Vinayak, that Bharat Ke Veer.
Yes.
That's a wonderful initiative. We'll do that. Sure. Thank you.
Yeah, sure. Thank you.
Jai Hind.
Good night.
Thank you. Good night.
Bye.